The main points that I see emerging from not just the tariff war is part of the geopolitical war. They're both interlinked. So let's go through this briefly. Fear and uncertainty abound, reflected in the fall in stock markets. Trump's shock and awe tariff policies, though well thought through, are dividing the world between those countries which want a negotiated trade settlement in return for a security umbrella and those countries that don't want to grow into being satellites of America. The divide is basically between America and her dependent countries and the BRICS group of nations. What is becoming clear is that Russia and China have taken decisions to stand firm against America. Just a few days before Trump's statement on tariff policy, Wang Yi, China's foreign minister, was in Moscow. On his return, China announced their imposition of a 34% tariff on the import of all American goods into China. China is not going to back down, even if America imposes more tariffs on Chinese exports. Nor will Russia agree a quick fix to the Ukrainian war. Now Trump is talking about negotiating directly with Iran, whereas Iran states that they will be in indirect negotiations with America. The terms that Trump has laid out on the 4th of February are based on a national security presidential memorandum, so a legally binding document that requires government agencies to carry out specific actions. The demands are basically the following: that Iran be denied a nuclear weapon, denied intercontinental missiles, denied other asymmetric and conventional weapons, imposing maximum economic pressure on Iran, and drive Iran's oil exports to zero. In short, if Trump keeps to these demands, and if Iran accepted them, the country would be open to anybody just walking into Iran and taking over power. That is exactly what America and Israel want. Regime change, backed by the late Shah's son, who lives in Virginia. Of course, Iran will decline these demands, and so the risk of an attack on the country rises. Russia and China will support Iran. Of that there is no doubt. Iran is central to the BRICS strategy, as both the North-South corridor and the East-West one is linked directly into Iran. China's long-term vision for Iran is to build the country's manufacturing sector using their own SOE companies, and then have Iran as their new export base. Cheaper labor plus China's manufacturing prowess will be an unbeatable combination. Coming back to the possible, if not probable, trade war between China and America. China has done their homework. No way will America be able to rebuild a new industrial base in anything less than 5 to 10 years. They don't have the skilled workforce. It will take months of planning before companies will decide whether to rebuild in America or locate plant offshore. Meanwhile, America does not have the capital goods, equipment capacity to furnish such a transition, and most of them anyway are imported from China. Here are a few examples that I picked up of the percentage of China's imports into different sectors of America. Consumer electronics, 39%. Home appliances, 24%. Textiles and clothing, 26%. Construction machinery, 60%. Electrical equipment, 23%. Transport equipment, 10%. So you have a trade war between China and America. Who is going to win it? I think that the odds are very high that it would be China that would win a trade war. But the big question is, will a trade war move into a real war? We come back to Iran. Perhaps the big objective of Trump's proposed attack on Iran is to deny China such a large percentage of its oil imports, something between 80 and 90%. How then would or could, some of my Chinese friends say would, China react? If China blockaded or invaded Taiwan, China would stop most of America's chip imports that originate from Taiwan. Do we get there? It's a toss of the coin. One of my closest Chinese friends, talking to him this morning, he said, watch out for wars. I said, you mean in Iran? He said, no, I mean Taiwan. So, it's an obvious. You want to play tough with us, we'll play tough with you. And the basic message is China and Russia are standing firm. And don't forget that next BRICS summit is only 3 months away in July in Rio de Janeiro. And you can bet your bottom dollar that the Sherpas have been working overtime creating their new trade, financial, and currency policies. The real question is, by going on an attacking policy to build up a defense army, etc., what actually are the governments hiding? They are hiding, one, hidden debt. If you look at the debt structure of the UK, it's pretty ominous. The same applies to France, other countries. Another issue is the migrant issue. And then you've got the electorate getting tired of being governed by unelected officials in Brussels. So the whole EU structure is under strain. And many of my friends in Europe give the EU less than 5 years before it breaks up. So war with Ukraine against Russia is hiding much bigger problems. I think watch out second half of this year. I think that's when the cracks will really start opening up, because a lot of the more optimistic tone from industry is, the war in the Ukraine is ending tomorrow. Well, it's not going to. The banks, I'm not a financial analyst, but I talk to those that are, and they say it's actually pretty dire. That's what we see in 2 to 3 years' time. We've seen the primary correction in equity markets, but primary falls always lead to secondary corrections. And the secondary correction is always the damaging one. I think that we're having a dead cat bounce now. I think the markets will then retest the recent lows at the end of this month and probably into early May. Then the central banks and the governments will introduce major monetary and fiscal stimuli, which will lead to an 18 to 24 month huge rally in equity markets. Inflation goes back to where we were in 1980, 13% in the USA. But what does that mean for long bond yields? Double digits.
Wow.
What does double digits do to financial markets and the world economy? Crash. So my basic message to our friends is play the cycles. Don't invest for the long term, because the long term, beyond 3 years, you're going to be in basically a depression. What we see first is a fall in the 10-year. That's when they will finance debt. We'll probably get 10 years down to 3%. The drop in the 10-year comes quite quickly, like by the end of this year. But what follows will be the inflationary takeoff, particularly if there is an attack on Iran. The world is going to be in recession, in our view, probably until the early months of next year. But the markets will bottom before then. So we've got the equity markets bottoming probably in the third quarter. But then, as I said before, the second fall, that is the damaging one, which will take us back to 4,200. So hitting probably 7.5 by early 2027. As soon as Trump announced his tariff policies, 3 bad bedfellows got together to start the process of establishing a free trade zone between them. Japan, South Korea, and China, who have not been good bedfellows, yet they've come together. Why? Because the future growth, whichever way you cut the cake, is not going to be in America. It's going to continue to be in Asia. I think there are conflicting forces. First one, I think gold is short-term overbought. Secondly, these high prices are a destructive influence on jewelry, which is the biggest demand for gold, bigger than the central bank demand. Next, if you're a big buyer, you would like a correction. And I think that America remains a big buyer. So we have a nice correction in the gold price over the next maybe 6 months, down to 2,500. And then we see the next leg of the bull market, which will probably take us close to $5,000 in 2028. But I think that a decade ago, based on a word that somebody dropped into my ear, you said, long term, Simon, they're going to be $2. It's going to be $1 for domestic use only, backed by gold. The offshore dollar will be allowed to find its own price level. So maybe what we are seeing is, first of all, I think Scott Bessent would not be lying when he says that the gold is still in Fort Knox. I think what happened is that a lot of it was leased out or hypothecated. That's why you've seen such panic buying to cover those shorts. But I think the next leg is to take America's gold reserves from 8,000 to over 10,000, with the ultimate objective, maybe I was right 10 years ago, of creating a domestic dollar based on gold. And what we also probably at some stage will see is that the Treasury will revalue gold to something closer to what the market is saying. And whether that's going to be this year or next year, or when the gold price goes much higher, remains to be seen. So our advice is, if your gold is deleverage, wait for the price to come back to 2.5 or around 2.5 over the next 6 months, then buy again.